The number one rule of a REIT is 95%, if not all of the net income is passed through to shareholders in the form of dividends. You can own the best assets at the best intersections with the most traffic that's going by there every single day and own it for $10, $25, $50, $100 a share, whatever it is. That puts some tailwinds for REITs. Why? It's the dividend.
Hello, everyone, and welcome. My name is Paul Palumbo. I'm the host of the Palumbo Podcast, where we interview some of the most successful founders of businesses, as well as investment professionals to learn about opportunities in the markets. Today, we have with us David Auerbach, Chief Investment Officer at Hoya Capital Real Estate. David is a true veteran of the REIT industry with nearly 25 years of experience in real estate securities. He's the driving force behind Hoya Capital's two exchange-traded funds, the Hoya Capital Housing ETF and the Hoya Capital High Dividend Yield, managing strategies that focus on delivering sustainable income and total returns to investors. Before joining Hoya Capital in 2023, David spent over a decade at Green Street Advisors as Vice President of Institutional Trading, working with hedge funds, pension funds, and institutional investors. He's also the publisher of the Daily REIT Beat newsletter, a widely followed industry publication that's been keeping REIT investors informed since 2006. When it comes to REITs, David, it looks like and sounds like we got the right guy.
First of all, thanks for that intro. I need more hype men like you. That was awesome. Thank you.
My pleasure. My pleasure. So David, let's first explain to the audience exactly what a REIT is.
A REIT is just a tax structure. That's all it is. For most of the companies that are out there, they're what we call bricks and mortar, physical, publicly traded equity REITs. So strip centers, apartment properties, self-storage properties, industrial warehouses. There's 20 different subsectors that make up the world of publicly traded REITs. So what happens is, let's say you're a Subway and you lease space in a shopping center. Subway pays the landlord rent, who then will turn around after taxes and expenses and passes through the net income to shareholders in the form of dividends. So as an example, if you're watching this conversation on YouTube, you are facilitating a data center REIT, such as Digital Realty or Equinix, to be viewing this. YouTube pays these companies rent, who indirectly then pass that income through to shareholders in the form of dividends. The number one rule of a REIT is 95%, if not all of the net income after all the various expenses, basically all the profit, is passed through to shareholders in the form of dividends.
So when I own in real estate investment trust, whether through a common stock or if I buy your ETF, in your ETF, there are common stocks of companies that own actual real estate, correct?
Correct. Yes.
Right. So if I own a common stock that owns real estate, I have a slice and a share of that common stock. But within a common stock, that company, the valuation is based on the real estate that they currently own. Is that correct?
You've got me so excited because you teed me up for the perfect example of this.
All right, here we go.
Where you're located, you are indirectly steps away from the most famous office building in the world, called Empire State Building, right? The ticker of that company is Empire State Realty Trust, ESRT. You can buy one share of Empire State Realty right now on the New York Stock Exchange.
$6.22.
So you can buy a share of the Empire State Building right now for $6.22 and own millions of square feet of other high quality office buildings that company owns. Or as an example, Kimco Shopping Centers, ticker is KIM. You can buy one share of Kimco and own a fractional interest in hundreds of shopping centers across the country, or Equity Residential and own a fractional unit in tens of thousands, if not hundreds of thousands of apartment units or hundreds of apartment properties across the country. That is the cool thing. You can own the best assets at the best intersections with the most traffic that's going by there every single day and own it for 10, 25, 50, $100 a share, whatever it is. The other cool thing is, and I don't want to knock the Mag 7 and all that stuff, because clearly that's what's really pushing portfolio performance over the years. It's very difficult to analyze NVIDIA in real time. Short of seeing Jensen speaking at CES or on a quarterly earnings call, you can't really tell how the company is doing every single day. But if you own, let's say, Kimco shopping centers as an example, and you have a Kimco property that's right down the street from you that you go and shop at every single week, you know how that property is doing. You see it in the parking lot. How many vacant storefronts are open? Is the light out on the sign in a particular name? Little things like that. And if that's just one example of what they own in the portfolio, think about what that may look like on a coast-to-coast basis in a lot of the properties that they own. So I like to say that at least with REITs, you can observe your investments in real time, 24/7. Look, see, smell, touch, feel, because we observe and invest with our eyes.
Okay, so now let's take an example where you have investors who will listen to this that actually invest in real estate on their own, whether they buy commercial real estate properties, multifamily units. I mean, typically when you buy a property, let's say it's $1 million and you put down 20, 30%, because you're leveraging 70% and you buy a cap rate, if you, let's say you buy at a cap rate of 6%, 7%, which is not easy to do today, but let's say you're fortunate enough to find something at a 6 cap, right? Your return on that investment, when you factor in depreciation and tax savings, et cetera, can be somewhere around 13, 14% over long periods of time. Again, if it's managed well, obviously, if the tenant pays on time and things like that, occupancy rates. But assuming that's the case, that's and then as you get the capital gains, you could do a 1031 exchange, save money on taxes, buy something bigger and bigger in a 20, 30, 40 year period. That's why you see a lot of wealth accumulation with many billionaires in the world is because of real estate. So if I'm saying to myself, well, David, I don't want to deal with the stress of buying real estate, dealing with tenants, and everything that's associated with owning real estate. If I own a common stock ETF like yours that has multiple common stocks in one ETF, and will I get comparable returns and tax savings as me investing in real estate on my own?
That's a great question. I've done a lot of these conversations, and frankly, nobody has really approached that question to me in the manner that you have. And I love it because there's pros and cons, frankly, of investing in public versus private. And obviously you stated on the issue of as the landlord, you don't have to deal with, when you own the stock, you don't have to deal with the maintenance, the upkeep, the taxes, and all. The dividends are taxed at your ordinary income rate that are passed through to you as the shareholder. As I like to say to folks, whatever happens with the stock price is the extra cherry on top of the sundae. I can't buy REITs based off of stock price performance because, gosh, if I knew where things were going, no disrespect, I'd be talking to you at my private jet on the way to Fiji right now because I figured it out. Nobody has figured it out. But here's what we can figure out is the dividend income stream of these companies. The perfect example is the most famous REIT of them all. Frankly, it's Realty Income. The ticker is the letter O. Their nickname is the monthly dividend company. So literally every single month, these guys consistently pay out dividends and grow their dividends over time. I like to kind of say to the end investor that's watching this, anybody that's buying any stocks that are out there, pick your favorite stock in the back of your head. Apple, NVIDIA, Microsoft, Tesla, Simon Property Group. You want that company to do 4 things at the end of the day. Very simple. Grow revenues, grow profits, grow your annual guidance, and grow your dividend. If the company can do those 4 things on a regular basis, then it doesn't matter what's going on in the bigger picture of the world. And by and large, that's what's happening with a lot of these publicly traded REITs is over time, with compounding dividends and returns, REITs are a great place to park some of that portfolio money because slow and steady wins the race. REITs are boring. Long-term lease income streams kind of float that ship along without the stress and day-to-day of being that private landlord. Also, frankly, Privates, they have long-term investment horizons. It's not necessarily easy to get out in case something happens. Little things like that kind of show why, a public exposure is a good complement to the private portfolio, if not a hedge, because again, if you're a private industrial warehouse owner and you know how well that's doing, then you can go out and buy an industrial REIT ETF like INDS, or go out and buy Prologis or some of these other industrial REITs that are out there, Rexford, Plymouth Industrial, Stag Industrial, the list goes on. And again, you can kind of complement your private portfolio with what you own in the public market. One more point to note, cap rates. There's a gap between public versus private cap rates. And so if the public guys are telling you we're in a 6 cap environment and the private guys say, no, we're in a 5 cap environment, who's right? Well, typically public leads private. So therefore you would really think it's closer to a 6 environment. So the public guys, because of the transparency, the press releases, the conference calls, all the disclosures that they do, they really provide a good information point for that private owner of what's happening in the world, of where cap rates are, what pricing looks like, since private doesn't typically disclose information the way that the publicly traded peers do.
Right. So as far as the dividends on these REITs, do they increase the dividends year after year due to increase in the rent roll from their tenants?
Great question. We said 80 REITs raised their dividends last year, actually.
By about what percent?
Let's say a few percent on average. I don't have the specific, 5% number, but S&P just put out a note today. Their number was 73 US REITs. So there's kind of varying things. But let's answer that question. Yes, increased rental stream boosts the dividend, but also things that were being developed last year that have come online and joined the portfolio this year that have leased up. When you go from 14 properties to 30 properties in a year, not only is your annual rent stream growing up, but frankly, the amount of rent you're collecting is growing up because your property base has grown. So there's a variety of different factors. And also, it's cutting expenses. I mean, obviously, for the management team, it's how do we maximize revenue growth, minimize expense growth to maximize our NOI that we're pushing out to shareholders.
Got it. And so when you look at private REITs, so some of the private REITs that I'm invested in for clients, the income that's being passed through is tax advantage due to the depreciation that gets passed through. So the income essentially is really not taxed. Obviously, when they go to sell it, if we sell it at some point, their basis gets reduced by the amount of income that they received over time. With public REITs, the income, you said it before, that's being distributed to shareholders, that is taxed at ordinary income or qualified dividend income, or not taxed?
It's taxed, as far as I understand, the ordinary income. But I also want to note on the private side, as you talked about, being kind of tax shelter, you're kind of paying some of that in the load going into, the fund. So, I mean, again, it's cheaper to buy public versus private, though they both have their pros and cons. But again, it's thinking about if you buy the REIT in the IRA, your Roth or something like that, think about how you're able to defer those taxes, obviously. And I always like to say, you just had your first child. You just had your first grandchild. The best present you can go out and give that child is go out and buy one share of, let's say, Realty Income or Agree Realty Trust in a DRIP, a dividend reinvestment, and literally just let that thing do what it's supposed to do. That by the time that person turns 25, 50, 75, tapping into the retirement, think about how much free shares have been created over those years because you just let the power of dividends do what they're supposed to do.
Real estate or REITs in general, over a long period of time, what type of return historically do you quote for investment?
There's great numbers from NAREIT. They have a great table that I could share with you that you could put into this that shows over the long periods of time what type of performance REITs have put up. Let's kind of focus in the more narrow time horizon there.
Right.
If you go back to the Fed rate hiking cycle that started in March of 22, REITs have underperformed the S&P by 70%, which is unprecedented in history. And a lot of that's not magnified because of obviously coming out of COVID, dividends haven't caught up. There's a variety of reasons.
Right.
A lot has changed, frankly, in the past few months. Number one, interest rates have been coming down. whoever the new chairperson is going to be going in, it has an aggressive interest rate policy cut stance in front of them. Number two, we are driven by what happens in the world of the 10-year. The 10-year controls all the headlines in the world of REITs. And I've always said the magic number is below 4%. If we can get the 10-year below 4, that puts some tailwinds for REITs. Why? It's the dividend. REIT dividend average is around 4 and change right now, give or take. If you buy preferreds, and we own preferreds in our dividend ETF, that the high dividend yield ETF, that adds probably an extra couple of 100 basis points of yield to it. So if the 10-year is at 4.5 and the REITs are at 4, it's more attractive to own fixed income. And so we want to see that change. But the other thing that's kind of pushing this is there's been a wave of M&A activity. There's been 37 REITs that have gone away in that time horizon, going back to March of 22. But in the past 5 months, 17 different REITs have either merged, explored options. It's all about management teams trying to find ways to unlock value for their shareholders. So it's cheaper to go out and buy an existing platform than develop new real estate right now.
So you believe that, which I agree with you, if rates do come down on the long end, the 10-year, which is suspect, right? You could have an environment where the yield curve steepens and the Fed cuts, but yet the long end goes up because of concerns of inflation. Then the story with REITs performance-wise, I think you'll probably get more of flattish type returns, not as bad as we've seen the past couple, 3 years in terms of the dispersion of S&P versus REITs. But I do believe, and I agree with you, which is really the same story with private equity, that if rates do come down, that could be very helpful to the asset class.
The lending window is wide open for these companies. These solid companies are able to raise hundreds of millions of dollars through the biggest Wall Street banks in a blink of an eye. It's not an extend and pretend. It's literally refinancing debt that was done a couple of years ago, where guys are able to borrow far and wide. We're seeing new REIT preferred offerings come to market. You're seeing new unique structures where, again, all of these companies, access to capital is wide open. So this is a sector that was once totally out of favor that isn't. Now, again, there's 20 subsectors. We could do a whole separate conversation going through all of these little subsectors, focusing on the winners and losers and the why. But as a whole, these long-term leases that these guys have, look, you want risk, you go out and buy a hotel REIT because that's a one-night contract. But an office lease, a strip center lease, something like that is usually 5 to 10 years in place. There's a company out there that focuses on ground leases that's a 99-year lease term. So you know what that income stream is going to look like from that lease over 99 years. So that's what I'm saying. These long-term leases have basically protected income streams, which makes that dividend somewhat protected as well.
Got it.
There's 200 REITs that are out there. As I mentioned when we were talking before, the world of REITs is like your graduating class of high school. You have the top 10%, the valedictorian, the salutatorian, the REITs that are in the S&P 500. You have the bottom 10%, the bullies, the troublemakers, the kids in detention, the REITs that have cut their dividends, or the REITs that are over-levered and are going concerns. But there's 150 students or REITs in the middle part of the curve that go under the radar that don't garner the headlines on a CNBC or a Bloomberg or some of the news stories that are out there, where the real good stories are happening. So I recommend anybody to kind of look at this sector with open eyes and thinking about how long-term leases could help your dividend portfolio and the income side of your portfolio, frankly, grow over the next 25 to 50 years.
I agree. David, great stuff. I really appreciate it. I think dividend income is terrific, especially from REITs with some opportunities for principal appreciation, the increase of the dividend also over time. So this has been terrific. You're a true professional in what you do and very knowledgeable. I appreciate your time today.
Thank you so much, Phil. I really appreciate it.
All right. Thank you.